The news is all abuzz about Buzz Aldrin, Neil Armstrong, and Michael Collins these days. But something you may not have known, we're going to talk about on this podcast.
You are listening to Wealth Talks. Yes, the news is all abuzz about the moon landing 50 years ago. This year, it's quite an amazing piece of history, and as we relive this history and celebrate the accomplishments of these men, there's something extra special that you would love to hear about on the show today.
Well, you know, before we get into that, John, let's talk about what the CSO tables are, Commissioner Standard Operating Tables. That's where actuaries get together and decide how long people are living, what their risks are to dying early, what their complications medically, what their driving history's like, what kind of activities are they involved in, like scuba diving or jumping out of aircraft, or in this case, going to the moon.
Going to the moon, yeah. You know, the astronauts could not get life insurance because they were considered high risk on these tables. They didn't fit anywhere on the CSO tables that the life insurance companies had to work with at this time. So what these CSO tables do, it's really a quantity of statistical data that the insurance companies are going through. It's really the actuaries at the insurance companies that are going through this data. They're the ones who sift through it, who make sense of it all, who apply it to the actual products that the life insurance companies are issuing. So what does this mean for us?
Well, that's an important fact because we are living longer as a society. So, you know, people born today have a much longer life expectancy. For example, when Social Security was actuarially computed, they thought people's life expectancy was 62. And wow. Social Security benefits didn't start till 65. They didn't expect really anybody ever to collect on it.
Interesting. So with the, as time goes on, as mortality, people become more long-lived, mortality rates change, these CSO tables have to be updated as well. So the industry just finished going through the process of updating the CSO tables here a couple years ago. So the latest copy of these CSO tables are the 2017 tables. Before that, it was the 2001 tables that all the insurance companies were working from.
And according to regulations, by 2020, everyone's got to have the new products out that comply with the new CSO tables.
Exactly.
Because everybody buying insurance at that time needs to be exposed to the same risk. Otherwise, insurance falls apart and it doesn't work like it's supposed to. So the regulators mandate that these CSO tables be done. The last one done was before 2017 was 2001.
Correct.
So they're updated periodically, and it gives people that are buying insurance a solid foundation to know that the product they're buying is based on actuarial science.
Right.
It lowers the risk for people purchasing it. It also cuts the risk down for the insurance companies because it's a mutual agreement between the product purchasers and the insurer to make sure that this is going to work for both people.
Sure. Now, obviously, because we're dealing with lifespan here on these CSO tables, you're not going to see dramatic changes on one of these tables. What we do see, though, is we see the changes in longevity affected. And let's talk about how this actually affects you, because, we're talking about the tables, but how does this actually come down to the you and me level? Well, the insurance companies, they redesign their products. The nice thing to know, though, is that no CSO table change is going to affect a product that you already have. If it was sold based on the older tables, then it's going to continue. The performances and calculations are still going to be based on those older tables. And that's always nice to know.
So we have the benefit of being able to purchase life insurance products based on those CSO tables. Buzz Aldrin, Neil Armstrong, and Michael Collins didn't have that option because they fit no place on the tables. The risk was too high. No one had been to the moon before. No one had been able to figure out what the risk was for them ever getting back to Earth. And so a month before the Apollo 11 blasted off, the astronauts were put into quarantine. And what they did, John, is they began to sign what were called covers. And covers in those days were like an envelope that would be postmarked a certain day with someone's signature on it for a special event or historic event. And if that could happen and coincide exactly with the postmark date, they became worth a lot of money. And so a month before they blasted off, they were in quarantine, and in their free time, these astronauts began to sign hundreds of covers, and they would get them out to a friend who then would postmark them on the day that the Apollo 11 blasted off, the day the lunar module departed and landed on the moon, and the reentry date.
All right.
And so, therefore, they knew that these would be profitable, even though that was long before eBay or any of the things where you could sell this kind of stuff. They knew that those covers, those envelopes with their signature on them and the postmarked date of the historic event
Would be collectible.
And sure enough, they are. They've been starting to show up in memorability, and those autographs are selling for $30,000 plus.
Okay.
Today. Now, fortunately, none of the astronauts on Apollo 11 needed to actually sell those, but it was the insurance, the life insurance, to make sure that their kids could still go to college, and that if their spouses became widows, that they would have enough money to continue to live the life that they would have lived had the astronauts not perished in the Apollo 11 mission.
Fascinating. So that's a creative alternative. Since these astronauts could not get life insurance, they were able to be creative. They found an alternative way to get the protection for their family that they needed. That's wonderful.
And you know, life insurance is centuries old. The Roman Senate did something very similar years ago. They realized that, hey, look, when one of our members dies, there is a financial burden there that can really cripple the family. And so they pulled together, and they had a fund for certain members of the Senate that joined that, so that if there was a death in the family, there wouldn't be such a tremendous financial burden for that family to bear. And later on, we see the guilds in Europe doing the same thing and building a fund to protect their members, the members of the guild. And then, of course, we see it starting here in the Americas as well. And now we have, the actuarial tables, the CSO tables that help us build the risk around that, so that everybody that is purchasing into that insurance pool is paying the exact same risk as anybody else that comes in.
So that's a fascinating story about the astronauts, the Roman Senate, everything else. Today, as we're looking at the changes in the CSO tables, we're going to be seeing, especially between now and the end of the year, the life insurance change, the companies. They're going to be changing their new products that will be available to be issued to match the 2017 CSO tables. So with people living longer, we're going to talk now about what you can expect to see in the policy values as this happens.
And that really depends on what the insurance company has invested in. Because, sometimes a company comes along, a real good investment, and they're able to project a much higher dividend because of this great investment. But investments don't last forever. It might last 10, 15, 20 years or less, or they might be in the middle of a good 10-year investment. So because they're able to then maybe to project a little higher dividend because they're still got a tailwind behind them. But eventually, it all pans out to be really close
to the same.
Yeah,
it does.
Because not everybody's going to hit it on the mark in an investment every year. And so, but some people are going to do, some companies are going to do better than others at different times. But they all have to meet the standard guidelines in the CSO tables. So we know that if we focus on the guarantees in the policy, we don't really have to worry about the projected dividends. That's what's guaranteed. And when we're looking at a life insurance contract, we're looking at 30, 40 years, maybe longer that policy is going to be existent. It's
Definitely
not going to be
long-term
one investment
proposal.
of the company that carries it over.
Sure. Absolutely. In fact, that's one of the reasons we're using the life insurance companies, because they can spread their portfolio out over investments, bond offerings that expire at different times throughout history. They're pooling all that risk together. They can do that, whereas an individual investor cannot. We can't spread the risk that thin. So, and of course, they give us the liquidity on that. But one of the things, we've looked at some illustrations across a few different companies, that are in the process of moving to the new CSO tables. We've looked at the old products. We compared it to the new products. Some of the general things that we're seeing across the board is long-term cash values are very close to the same. One company, particularly that I'm thinking about, was a little bit higher on the new CSO tables in later years. Early on, in the early years, the cash value part tends to be slightly lower. Not significantly lower. It just is going to take a little bit longer to capitalize the new policy. That's because people are living longer.
They got to cover. The insurance companies have to cover their risk, or they can't offer a product at all. Because if we're living longer, they've got to collect more up front for the compound growth to take effect when they know they're going to have to pay a death benefit.
Yeah. And some companies are adjusting, how quickly they are going to recover the cost of a new policy. That's built into the different product designs. Across the board, generally, that's what we're seeing now. Very close to the same, or even possibly a little bit higher values later down the road, long term. And short term, like within the first 10 years or so, we're seeing a little bit slower growth on the cash values.
So, John, this brings up something else that we were talking about over lunch today, and that is when someone has a policy that's, maybe 9, 10, 11 years old, and they decide, hey, I'm really tired of this. I just want to get rid of it because I can get a higher rate of return somewhere else. And we were talking about how a life insurance policy can provide, an 8 to 12% rate of return annually at that point, based on what you paid in cash value and what your guaranteed cash values turn out to be.
Yeah, it's fascinating how that works.
That's because
what you pay in premium versus how much it grows that year.
And the reason is that the expense of getting the insurance has now been taken care of. And often the way a lot of prospects and clients see that when they look at these numbers, they say, wow, if I'd been buying term all this year for this coverage, I wouldn't have anything back. Now I've got all the money back that I paid for this policy, and every year from here on out, when I pay my premium, I get a greater amount of cash value appearing there than what I paid in premium.
Exactly. And that's a rate of return you don't have to pay taxes on, and you don't have to pay management fees or anything else. The rate of return you would have to earn in the market to counterbalance that is much higher.
Yes.
It's almost unrealistic in the market environment that we have today.
It really is, because when you look at taxes and when you look at fees and when you look at just the cost of trading, changing your portfolio around, juggling it around, those fees can take a big chunk out of what you thought was yours.
Yeah. What's the number Jack Bogle quotes?
Well, Jack Bogle says in his book, Don't Count on It, that on a 2.5% fee, by the time you consider taxes and inflation, you end up with hardly anything.
That's amazing.
And he goes on to say that with proper planning, we can avoid taxation almost completely and the fees. And of course, that's something that life insurance provides for us. We can avoid almost all that and end up with a lot more. And then all we have to deal with is inflation, because that's
something that affects everybody.
It affects everybody.
That's right. And I think life insurance is a better way to deal with inflation than the people that want to buy, say, something like gold. Because with the life insurance, you can actually use that money along. It's getting a nominal, return, an internal rate of return over the years, but you can still access and use that money along the way if you have opportunities that come up. Gold, it can go up over the years. Maybe it's nice to have a little chunk of gold or silver as a savings in case a big catastrophe comes along. But how are you going to convert that and actually use it? You can't use it along the way without selling it first in our economy. So aren't you losing a lot of opportunity cost? And inflation, maybe it'll be there, maybe it is. It depends on the market at the time that you need to sell your gold or silver.
Well, gold and silver are great commodities, and they do have value, and they have kept their value. But the problem is they're not liquid.
Yeah,
and that's the reason that we deal with money today, because they're not liquid. People didn't want to lug that stuff around. They didn't want to expose themselves to an environment that knew they had lots of gold stored, because now became targets for theft or robbery. And so those things are still true today. Mm-hmm. It doesn't mean that it's a bad investment. It's just that it's not liquid. Mm-hmm. And it keeps us from being able to use our money and have it grow at the same time.
That's right. So takeaways for the CSO tables. What should you be thinking as you're looking to, is now a good time to buy the policy while it's still on the old CSO tables? Is it going to be good next year as well? Could you tell us a little bit about what the perspective is looking forward?
Well, the best time to buy life insurance is before you need it. And so regardless of where the CSO tables, I remember when the 2001 tables went into effect, and we saw the same change. You had to spend more money on the base. Mm-hmm. People were living longer, so the insurance companies had to cover their risk up front, because that's what they do best, and that's what makes insurance worth purchasing. It's just the rules of the road, John. We don't really have to worry about it. We know that everybody's going to be participating in these same tables by 2020. So we just, if it's affordable and comfortable for you to get moving and getting your policy in force before 2020, it's a good time to do it. And if it's not comfortable and affordable, then there's going to be a good product for you in 2020 as well.
That's right. And that really is what it comes down to. When is affordable and comfortable? When is the cash flow there for you to get the life insurance coverage that you need? The same qualities that we always talk about in the participating whole life insurance are still there, strong and loud, on the new CSO tables, on the old CSO tables. I mean, like we said, they don't change all that much. You just have these differences in longevity, the market environment reflected in the new product design. So very, very good point. Any final words for the on the CSO tables?
Well, I just can't help but going back to Buzz Aldrin and Neil Armstrong and Michael Collins, and how brilliant they were to think ahead and to actually think about taking care of their family. You know, that's the sad thing that we see today, is so many people say they don't really care if they have a death benefit. And these three heroes, these fellows that, make us all proud to be Americans, were willing to think of that before they took on this dangerous mission. And I just think it speaks volumes for people that want to make sure that whether they're there or not, they're thinking about the future, because the future is so important for us to carry on the values that America has. And that's why I'm so proud to be part of the life insurance industry.
So until next week, we'll be back here on Wealth Talks, where we talk about solutions, money, and other things that create wealth in your life. Have a great week.